The depth of the U.S. federal government expressed has varied throughout history. Wartime spending is typically associated with subtle increases in government debt. The debt to GDP ratio is one gauge of the government's finances. Because GDP is a rough measure of the government's tax base, a declining debt to GDP ratio indicates the government indebtedness is shrinking relative to its ability to raise tax revenue. By contrast, a rising debt to GDP ratio means that the government indebtedness is increasing relative to its ability to raise tax revenue. Throughout history, the primary cause of fluctuations in government debt has been war. When the war is over, government spending declines and the debt to GDP ratio starts declining as well. When a war occurs, government spending on national defense rises substantially to pay for soldiers and military equipment. Taxes sometimes rise, but typically by much less than the increase in spending. The result is a deficit and increasing government debt. There are two reasons to believe debt financing of war is appropriate. First, government to keep tax rates smooth over time. Without debt financing, wars would require sharp increases in taxes, which would cause a substantial decline in economic efficiency. Second, debt financing of wars shifts part of the cost to future generations. One large increase in government debt that cannot be explained by war is the increase that occurred around 1980. When President Reagan took office, he committed to smaller government and lower taxes. Through Reagan's time in office, government debt rose from 26% of GDP in 1980 to 48% of GDP in 1993. Because government budget deficits reduce national savings, investment, and long-run growth, the rise in government debt during the 80s troubled many economists and policymakers. At another time, President Bush signed into law several major cuts, which he had promised during the 2000 presidential campaign. In 2001, the economy experienced a recession, which automatically decreased tax revenue and increased government spending. There were increases in government spending and homeland security following the 2001 attacks and subsequent wars in Iraq and Afghanistan. These events led to a rise in debt to GDP ratio under George Bush. After 2012, as the economy recovered, the budget deficit shrank and the debt to GDP ratio stabilized. But many budget analysts are concerned with increases in debt to GDP ratio going forward. One reason is that President Trump enacted significant tax cuts beginning in 2018. Another important concern is the large baby boomer generation will reach retirement. They will become eligible for Social Security and Medicare benefits, putting upward pressure on government spending. Without sizable increases in tax revenue or cuts in government spending, the U.S. federal government will likely experience rising debt to GDP ratio over the next few decades. Let's discuss key elements of a financial crisis. The first element of a financial crisis is a large decline in prices of some assets. In 2008 and 2009, that asset was real estate. The second element of a financial crisis is widespread insolvencies of financial institutions. A company is insolvent when its liabilities exceed the value of its assets. In 2009, banks and other financial firms have placed bets on housing prices by holding mortgages backed by that real estate. Third element of financial crisis is a declining confidence in financial institutions. People start pulling their money out of banks and financial institutions. Fourth element is the credit crunch. People began having trouble getting loans, with many financial institutions facing difficulties. The fifth element of financial crisis is an economic downturn. With people unable to obtain financing for new investment projects, the overall demand for goods and services decline. The sixth and final element is a vicious circle. The economic downturn reduced profitability of many companies and the value of many assets.